A couple of words immediately come to mind: fragmentation and transparency. We are in the post-MiFID II MiFIR review time period and anticipating a new transparency regime to be applied in the UK as of December and in the EU as of March next year. There is going to be more real-time transparency. The EU also has something called a plus 15 minutes after real-time transparency, and there will also be the establishment of the two respective CTPs for both the UK and the EU. And so the question is what new info will be available and how to ingest that to make better pre-trade decisions. We're also in a busy year of other regulatory implementation. I just mentioned the new transparency regimes, but there is also EMEA 3, which affects a large proportion of EU investors, and a follow-on from the European Commission's targeted consultation for Savings and Investment Union. This is all happening in the backdrop of clients managing a growing complexity of choice and execution, which in itself, I think, is a positive development as it shows adaptability and innovation in our industry. One last thing that I've also noticed is that there's more discussion across the asset classes or the markets. We've previously heard of an equitization of fixed income markets, but I'm witnessing more sort of a lesson taking from fixed income taken into the equities markets, be that on price discovery and transparency of exchange or innovation in the use of trading protocols. So we are keeping very close to regulatory developments and making sure to stay engaged with policymakers and regulators. Market structure is evolving, and so is regulation. It's an iterative process where innovation is driving our clients and driving us to respond in kind. And also, it's not just regulation or innovation in our sector that's driving the change in market structure. There are strong outside influences here as well. The decentralized finance sector or new technologies are compelling regulators to consider and actually implement shorter settlement cycles and using technology like DLT to move to immediate settlement even in the future. The way things are done is fundamentally being questioned, and what is not changing, however, is how we at Tradeweb are putting our clients first and helping them to adapt. There are three elements, in my opinion, that impact the European regulatory horizon. The first is macro. So these are obviously political pressures that market participants have to take into consideration when searching for liquidity in the market. The second is micro, so the impact of current regulatory frameworks and any future reviews of these rules. On that note, there is a significant market structure legislative proposal that we're expecting in November in the EU. And the third is external pressures. So as I said before, this is the increasing use of technology and DLT in our sector. Overall, the European financial landscape is changing as well. The fundamental structure of savings and investments and the options available to EU savers is looking to be reviewed. And this change in the retail base, in my opinion, will undoubtedly bubble up to the institutional layer. There's also growing regulatory and market comfort with electronic trading. And obviously that is a positive development for us. But to borrow words from my boss, Enrico Bruni, there is still lots of opportunities for electronification in developed markets. For further electronification to occur, the electronic rails have to be put in place. And that is what we're doing parallel to supporting regulatory efforts. Whatever the challenges are, Tradeweb is here to address these concerns.